So time value of money is very much the cornerstone of the field. It's basically what finance is kind of built around, right? The value of anything is what we expect to get from it, but the value of things change over time, especially the value of money and the value of assets in general. Right? So if the value of something is what we expect to get from it, then we have to make adjustments for when we get it. Right? If we're going to receive $1 today, that dollar is worth itself. If we receive $1 a year from now, it's worth a little bit less. Right? We can't make decisions with that dollar between now and a year from now. There's the effect of inflation reducing the purchasing power of that dollar. And basically, the further into the future we would get that money, the less it's going to be worth today. Right? The more time between, there's things we can do with it, the opportunity cost of it, the erosion of purchasing power through inflation, and the opportunity cost of foregoing that extra consumption. Right? So the further into the future we receive money, the less it's going to be worth today. Of course, further into the past we look at it, the more valuable it would be relative to today. So it's always important that we adjust for the timing of cash flows, right? And that's what time value of money all comes down to, is just adjusting for the difference on when something occurs. So time value of money is what we're going to be doing, and as you are all familiar with by now, right? This is how we get this equivalent basis to judge the value of an asset. And there's a few specific ways that we can use time value to be helpful for adjusting for time. Those two main components are present and future value. Right? With present values, we're estimating some future cash flow and trying to figure out what they're worth today. And what we're primarily interested with present values are making investment decisions. Right? We take the present value, compare it to the cost of purchasing access to those future cash flows, and compare and contrast, is this present value worth more or less than the cost of entry? That's basically what a firm valuation comes down to, like you're doing with your project. You're taking the cash flows, getting the ongoing value of the firm in perpetuity, discounting it all back to today, and then comparing that value to its price, right? The price is just the cost to have access to these future cash flows. So whether you're dealing with a financial asset or some sort of operating asset with an actual company, these assets are generating some sort of expected cash flow. And we have to compare what the value of those future cash flows are worth relative to the cost of entry or the price of access, right? The investment we would have to make today. So present value is primarily interested in making decisions today about what something is worth and comparing it to the price of access to those future cash flows. Future value is just the mere opposite of present value, right? With present values, we're declining the value back to today. With future values, we're compounding into the future. So with future value, we have some cash flow, and we're trying to figure out what it's going to be worth sometime in the future. Right? So whereas present values are trying to make decisions today, future values are making decisions today and how they're going to grow into the future, primarily around retirement planning. Right? In planning retirement, you need some degree of money in order to live off of. And so you can figure out how much you have to save up throughout the course of your career to have a comfortable nest egg to live off of, or if you want to do other things with it, if you want money left over to pass down to kids, grandkids, stuff like that, or to causes that you find important, then you can calculate the value of your savings and what they're going to be worth in the future using the present value. Right, so present and future value are the two main components. We do also have the number of time periods and the discount rate, but generally we're not concerned with applying time value money to calculate those for a couple of reasons. So number of periods usually is assumed or given to some extent, right? With bonds, you're told exactly what the time frame for those bonds is going to be. So you know ahead of time, right? It's a fixed income instrument. What's fixed is the number of time periods you're going to be receiving those coupons and when you're going to be receiving the par value at the end of the investment. With perpetuity, one of the other ways we can look at it is the perpetuity formula that you're valuing the asset at, right? So typically, valuation models will forecast cash flows going somewhere between 3 and 10 years into the future, and then you'll estimate it at a perpetuity value. You'll assume that the company is going to be able to continue going forever. That's part of the point of a corporation, that you have this entity that exists independent of the people that run it, and you can just change the people that are running it over time. That's why we have companies that are centuries old, and the people working for them aren't as old as the company itself. Right, so typically the number of time periods is either known or assumed to some extent, so we don't really need to apply time value of money in most cases to calculate the number of time periods. Similarly, with rate, we have our own separate method that we ended up talking about at the end of class, right? The weighted average cost of capital. That's how we estimate the discount rate that we're applying to projects and companies. If we're looking at a specific asset, we can use the individual components of time value of money to get the expected return on those specific assets, right? If we want to figure out the expected return on equity, we have the Gordon growth model, we have CAPM, we have some other ones that we didn't talk about, but we have these methods to calculate that expected return, which in equilibrium is the same thing as the discount rate. Expected returns, discount rates, they're the same thing, just depends on what time period you're looking at those rates at. Right. A little bit of an extension of time value of money is using multiple cash flows. Right, and that's going to be the discounted cash flow analysis. So works similar way, right? But we have these steps that we have to go through to make sure that we're evaluating it correctly, right? First step, we set up our cash flow, we set up our time period, right? Very important that we understand what time periods we're dealing with here. So you establish your time periods, step one. Step two, you allocate your cash flows to the appropriate time period. Right? Time value of money, we know the timing of cash matters. The year we allocate a cash flow to is important to the value of that cash. So it's important that we allocate our cash flows to the correct year. Step three, we take our present or future values of all of those cash flows in each year. Final step, we add up all those discounted or compounded cash flows. Same 4 steps every time. Often what gets to be the most complicated aspect is putting together those cash flows. Right, well, the amount of information that goes into calculating free cash flow can be pretty onerous, so that can take a lot of time. But always going to be those 4 steps. Right? There's different assets that this may be applied to in slightly different ways. Right, if you're dealing with an option, then you start getting into the probability of different cash flow streams under different conditions. But you're still fundamentally looking at the same thing. The only thing you're doing is kind of complicating the cash flow streams a little bit. Also, with time value of money, we have to know our discount rates, and that, like I mentioned, is going to be through WACC. Right, so weighted average cost of capital, it can include every source of capital. It can include leases, real options that companies use to finance themselves, other forms of external debt, such as private loans, direct lending to other companies, to other investment funds. But we're focusing on public debt and equity. Right, a couple reasons. These are kind of standard external sources of capital people use to estimate discount rates, so it's kind of standard practice to use them. In part because there's a lot of information available to them. Right, when you go look up a company's ticker, very quickly you can get a lot of the information you need to calculate its cost of equity through the Gordon growth, through capital asset pricing model. Similar with dividends, right? If you just look at bond issues that companies list in their financial statements, you can see their cost of equity. You can also go to the resources like the Damodaran website to get estimates on the cost of debt across different industries. All right, so we have a lot of resources available to us to calculate companies' WACC that we can be using. The calculation itself is relatively straightforward. We take the weight of each asset, multiply it by the cost of that asset, and sum it all up. In the case of equity, we have our cost of equity, again, estimated through the Gordon growth model, or CAPM, times the weight of equity, which is just the market cap of equity divided by the total market value of the firm, which is the sum of equity and debt. We take the weight of debt times the net of tax cost of debt, right? The net of tax here is very important. It's keep in mind, right? Companies have their interest expenses on their income statement, meaning companies reduce their taxable income by posting their interest expenses on their income statement. So it's reducing their taxable income, it's saving them some money. That's why we're getting our net of tax cost of debt, because we have this interest rate tax shield that comes out on the income statement. All right. So a company, a firm specifically, typically a for-profit business that's producing something, and the goal of the company is going to be to maximize value. Right? And the way that you can maximize value is by increasing free cash flow over the long run. And over the long run, the most important way to maximize that cash flow is by investing in value-adding projects. right? And we have some tools available to us as financial managers that we can help figure out how to allocate capital to the projects that are expected to add the most value. In addition to that, we can also reduce inefficient costs, right? Well, another great way to try to increase company's value is to reduce its discount rate. If you reduce a company's discount rate, right, remember that inverse relationship between present values and discount rates, we reduce the WACC, in other words, the discount rate of the company, and we're going to increase its value. And there's also the inefficient projects that have been ongoing, right? A sign of a really good manager is someone that understands that they've made an investment that may not be working out, and it's better to cut the losses rather than holding on to them and generating negative cash flows moving forward. Right, so we can reduce discount rates, we can get rid of unprofitable projects. All that goes about to increasing company value. So as a financial manager, how can we contribute to increasing the value of the company? Again, most important part is long-term investing, right? In other words, capital budgeting. And what we're doing here is basically estimating the value of various projects that are available. Right, so how does this go about adding value? Well, for one, it's getting straight to the bottom line. Right? By projecting the value of a project, we're getting to the bottom line estimate of how to add value and by how much. Right? When we calculate the net present value, that's getting us how much value is being created or destroyed should the company accept this project. Right? So when we see that NPV estimate, that's telling us the bottom line goal. How much value is being created or destroyed should we accept this project? So long-term investing, how do we go about adding value? Through capital budgeting by applying the capital budgeting tools that we went over, particularly NPV. We do have other things at our disposal to use in conjunction with NPV, right? If people like looking at rates, you can use the internal rate of return, being aware that, right, we might get multiple answers for the same inputs. It's rare occurrence, but it does happen. We have profitability index, similar to NPV, but the only difference is it doesn't give us as good of a sense of scale. And we also have the payback period, right? That's not an objective criteria, but gives you a time frame to understand how long it's going to take to recoup the startup costs of the company, of the project. And then we have long-term financing. In other words, managing a company's discount rate, right? So we can increase value over the long run by reducing the cost of capital to the firm. Problem is, a lot of it is not directly in management discretion. Management has some control over the leverage that the company has outstanding, but they have a more difficult time getting the cost of debt and cost of equity managed. Right, so if we hold fixed the expected cost of debt and the expected cost of equity, then managers can increase the company's value by balancing debt and equity, right? That optimal capital structure theory. They can balance debt and equity in a way to try to reduce the company's weighted average cost of capital. Keeping in mind that if you have too much debt, you're increasing the company's probability of financial distress. So you're going to increase the riskiness of the firm, and it's going to drastically increase the cost of equity as well as the cost of debt. On the other side, if you don't have enough debt, right, you're basically foregoing interest, the interest tax shields associated with debt. Right, so managers can add value through managing a company's financial leverage, particularly with their debt and equity balance. They can also do so with following the suggestions of the pecking order theory of capital structure, right? By exhausting the cheapest financing resources first, you're ensuring that the company isn't taking on too many sources of capital that are going to be too expensive. And also over the short run, there are ways to increase the company's cash flow just by managing their working capital, right? Accounts receivable and payable for the most part. As we saw when we were calculating free cash flow, if we reduce the accounts receivable, in other words, assets being tied up in the production process, we're increasing the company's cash flow. On the other hand, if we're increasing our accounts payable, in other words, extending the time period until we have to pay some resource back in full, then we're going to be increasing the company's cash flow. So these are the main ways that financial managers can add value to the firm. And to an extent, they're listed in order of relative importance to a company, right? Companies have to make long-run investments in value-adding projects. Right? If they're not doing that, eventually they're going to be outcompeted. Someone else is going to come in and they're going to basically outcompete them. Long-term financing is really important, right? Through reducing a company's cost of debt. On the flip side, this can be something that can destroy a company if they over-leverage themselves. So very important to keep in mind and not over leveraging a company that's going to increase the company's probability of financial distress and increase their cost of financing moving forward. And short-term working capital, this can add some value, right? As we saw with the supply chain issue during COVID, right? A lot of companies had moved towards the lean production process exactly because having that lean production process is increasing free cash flow, right? By having minimal accounts receivable, they're increasing their cash flow, right? So we do see that there are some trade-offs there, and there are some issues potentially with focusing too much on that. But it is a way that financial managers can add value to the firm. So with raising money, most cash comes from previously profitable years, right? So in other words, they're coming from internal capital markets. But companies can go to other sources of external capital. So they can go to banks, they can go to private bonds placed directly with investment companies, public bonds, and they can also issue different forms of equity, right? Common equity being also one of the most commonly forms of equity raised. Right, so why are we focusing on bonds and stocks in this class? Again, like I mentioned, very often they are the sources of external capital that are focused on when calculating a company's discount rate, right? So it's important to understand the basics of it because it's used so frequently. They do also, to a very large extent, make up the majority of a company's external capital, right? If you look at a company's market value of equity relative to the value of the other sources of capital they have, they're relatively small amounts. Right, so common stock typically makes up a very large proportion of public companies' outstanding capital. Debt might be issued much more frequently, and it is, but as an overall source of external capital, it's relatively small relative to companies' equity. It's important to also keep in mind the differences between bonds and stocks. Right? Bonds are a claim to a company's future cash flow, whereas common stock are claims to the company itself and the residual cash flows that the company makes in the future, right? So once bondholders are paid out, they don't have any additional claims, right? So if bondholders are owed, say, $100 a bond every year, once that $100 is paid out to each bondholder, then any dollar generated above that is going to the common equity owners, right? The shareholders. So bondholders are claims to specific cash flows the companies are generated, and they don't have any claims beyond those cash flows being satisfied that are allocated to the bond. They are a prioritized claimant, meaning that if the company starts experiencing financial distress, then if the company starts selling off assets and starting shuttering down, then the bondholders have priority claims to that company's cash flows. Stockholders don't have that luxury, right? They're a residual claimant. They only get any value if there is any left over after other stakeholders have been paid out. And this is part of the reason why free cash flow is focused on, is because it's a measure of that residual value being generated. Once every other stakeholder in the company is paid, only after that has occurred is there any value being left over for shareholders. So by focusing on the last person in line, it's, in other words, establishing that every other stakeholder in that line is being paid out before we get to the last person in that line. All right, so what do we do with capital budgeting? Companies have limited resources, right? This is a cornerstone of general economic thought, right? It's the economics is about the allocation of limited resources in many ways, right? And how people go about allocating those resources. Companies have limited resources just like all individuals do. Difference is, right, companies are a agglomeration of many resources accumulated over potentially long time periods. So they have nominally a lot more resources available to the firm itself relative to any individual, right? So although they do have a lot more money than us as individuals, they are still limited in the capital that they have available to them. So sometimes they have to find ways to generate the highest return on their investments. So that, in other words, they have to allocate their limited resources as optimally as possible. Right. So how is that optimization found? It's by estimating the free cash flows of a given project, discounting them back to today, adding it all up. DCF problem, pretty much. Right. So capital budgeting is that process. It's basically the process of going about trying to find the best ways to invest money. we always have to evaluate the expected cash flows of the proposed investment. As we saw in those surveys of CFOs, right, it turns out that that is the most prominent method used, but there are other methods that managers use in order to make decisions, right? How confident are they in the manager? How valuable are the manager's previous projects that they've suggested in the past, right? So there are qualitative aspects that people impose on the capital budgeting process, but fundamentally, the best way to go about it is to ignore our qualitative senses, and basically, if we want to use them, embed them in our expected value of a project, right? If you're very confident in the prospects of a cash flow moving forward, right, maybe it would be more appropriate to have a slightly lower discount rate, right? When we were talking about those changes to WACC, right? If it's a less risky project than we're expecting, then maybe we should apply a lower discount rate to it, in which case it would be increasing the value of the firm, right? So there are many ways we can go about evaluating the expected cash flows, and it's important that we attempt to do our best to do so without adding in our own personal biases on what those expected cash flows are going to be. Right? And speaking of cash flows, profits are not equal to cash flow, right? Very often profit is what is talked about when discussing company value, but profits are not the tangible value that we're concerned with. Right? So profits are book accounting values that are recognized on the income statement, whereas cash flows are tangible changes in cash that occur over a given time period. Right? So the only time profits equal cash flows is if all revenues and expenses are paid for in cash. If there is not a single ounce of capital raised, if there is not a single product or service made on sale credit, if there's not a single purchase on sale or credit, then profit is going to equal cash flow. But in practice, typically that's not what we see. Right? Companies very often go to external sources for funding opportunities. Companies very often will sell products and services on credit. We've seen that become an increasingly popular way to pay for things. And we also see that companies themselves also tend to not pay for something immediately in cash if they're able to have an account and extend that cash payments sometime into the future. Right? So in practice, no, profits are not equal to cash flows, and we very rarely, if ever, see that condition where profits are equal to cash flow. Right? But it's the cash flow that companies generate that is relevant to the value of the firm. Right? It is a measure of how much value is created or destroyed over a given time period, and it makes adjustments to the accounting values of book profits that adjust for actual changes in cash. Right? So we can start with net income at the bottom of the income statement, but we're making adjustments to it. Right? So first, we're adding back depreciation and amortization. Right? That is a non-cash expense that companies deduct on their income statement. Right? When you drive a car off the lot, you're not taking money out of your pocket and throwing it out the window as you're driving the car around. The value of the car just declines over time. That's the nature of a lot of operating assets. Right? They have a limited useful life, and so the more you use it, the less useful that asset is going to be over time, and that's just a matter of depreciation. But it does not mean you're paying cash out of pocket for that depreciation. It's just an accounting expense that recognizes the value of assets decline over time, and companies can expense that on their income statement. Right? Capital expenditures, on the other hand, are tangible cash outflows, but are not recognized necessarily on companies' income statements. Right? So we net out capital expenditures as well. And finally, changes in net working capital are a cash expense because they reflect cash that's being tied up in current assets or freed up in current liabilities. So we want to make those adjustments because profits are not actually equal to tangible changes in cash. So we make that adjustment to the income statement in order to arrive at cash flow. All right. Another method we can use is looking at the operating cash flow measure of free cash flow. Right? So the three statements that we're concerned with, the income statement, the balance sheet, and the cash flow statement, right? We can calculate all this from the income statement and balance sheet typically, but very often the cash flow statement will have the information we need as well, directly calculated for us. One small issue, right? Companies do have discretion over calculating their free cash flow, so sometimes it's a good idea to go in and see in their financial statement how exactly they choose to calculate free cash flow. Right, so another method that we can take here is looking at the operating cash flow of the firm. So earnings before interest and taxes plus depreciation minus taxes. right? So money being generated from a company's typical operating activity. Then we net out actual spending on assets, right? Money that's spent on assets, net of any money that you've received for selling assets off. Right? We can calculate this through change in property, plant, and equipment. And finally, we have change in net working capital, right? Again, money that's being tied up in current assets, money being freed up in current liabilities. So now we know how we're calculating cash flow. Now we bring it all together with net present value. And so we know we have to allocate our cash flow to the appropriate time period. NPV is how we're going to figure out the sum total value of a project, whether it's going to be adding or destroying value should it be accepted. All right, so net present value reflects the difference between the market value of the cash flows relative to its cost. All right, so in other words, it's a time value money problem. We establish our time periods, we allocate our cash flows, discount our cash flows, including net of all expenditures, sum it all up. Right? So when we're dealing with the project, often CapEx is going to reflect startup funding for a specific project. And when we're dealing with the company overall, it just reflects those average expenditures over time. When we're also dealing with a project relative to a firm overall, right, with that project itself, we might see salvage value coming out at the end of the project's life. Right, so whereas CapEx in the firm is basically built in as just the change in average expenses relative to disposal, salvage value received in each year. In a specific project, we're going to have that ramp up period at the beginning of the time period. That's where we can include time zero with NPV because it's still being forecasted. The project has not started, so time zero hasn't occurred yet. And also a big difference between valuing firms and projects themselves are the salvage value being explicitly included, as well as netting out. I forgot to include here in PowerPoint, but in addition to that, a big difference between valuing firms and projects is we have to make sure that we're zeroing out our change in net working capital for a finite life project. Right? In other words, we're collecting everything that's owed to us and paying everything we owe. Right? And NPV is across the board the best valuation technique to use. It's getting straight to the bottom line goal of a company. How much value is being created or destroyed if we were to accept this project? So it's getting straight towards answering that question of, how are we generating value and how much value is this specific project going to be adding? Right, so NPV is going to be the best metric to use when estimating value. There are other methods that are used, right? Internal rate of return. This is the discount rate that sets the NPV equal to zero. Remember, inverse relationship between present values and discount rates. The higher the discount rate, the lower the present value. And this is basically just telling us how high does the discount rate have to be until the NPV is equal to zero. The higher that discount rate has to be, the more value is going to be generated. Right. So with NPV, the bottom line decision criteria is NPV greater or less than zero? If NPV is greater than zero, accept. If less than zero, reject. In practice, right, we want to be aware of the scale of how much value is being created. Right. So the more expected value that's expected to be generated by a project, the more likely it is to generate a positive value to the company. With internal rate of return, it's a little bit different. We're comparing the internal rate of return to the company's weighted average cost of capital. If the internal rate of return is greater than the discount rate, accept the project. In general, it should agree with NPV because it is based on the NPV. That's the rate that's NPV equals zero. We also have profitability index, present value of all future cash flows divided by the initial cost. Basically, it's a benefit to cost ratio. And if it's greater than one, accept, less than one, reject. All right. And we do have this technicality where we're going to be indifferent either way, where accepting a project won't create or destroy value, so it doesn't really matter. And this should also tend to agree with NPV. One big issue with profitability index and IRR is they don't give us a sense of scale. Right? If you have a PI of 20 million, right? But really you're dealing with a project that has a startup cost of like $1 and you're generating a couple of bucks. Actually, no, that doesn't work. That would still be a lot of value. Right? right? If you're dealing with a project that has an investment cost of like a penny, right? PI ignores scale. Is basically what I'm getting at. It's similar with internal rate of return. And it's important to keep in mind that sense of scale, because when you're rank ordering projects, you're concerned with how much value is being created or destroyed. So whereas you might have a project that generates a higher return on investment percentage-wise, right? If that percentage is relative to a small overall cash flow, then maybe it's not going to be worthwhile. And finally, we have the payback period, right? How much time to recoup the initial investment. Problem with it, there is no hard and fast rule. Investors have to decide what is a sufficient time period to be repaid. And even worse is it's not adjusting for time value of money. So there are workarounds we can do to adjust for time value of money, but that still doesn't help alleviate this arbitrary criteria. Very often it's going to be a little bit more relevant for riskier startup sort of projects, where, right, the further out you expect the cash flow in general, the less likely it is that cash flow is going to occur. Right? Also in situations where the company knows they have this excess capital for a limited amount of time, right, that they're going to need to use it for some specific purpose in the future. So payback period can be helpful in figuring out how to deal with money that's only freed up for a certain time period. All right. So dividend policy of the company, right? Everything basically ties back to this question of, is a decision adding or destroying value, right? So when we're dealing with any sort of firm practice, that's what we want to compare it to. Is it adding or destroying value? So when we're looking with companies' dividends, right? Why do companies pay dividends? So the best reason would be the company's return on invested capital is lower than the rate of return investors can earn in the market. So they should just pay out this excess capital rather than investing it in lower investment opportunities that investors would prefer to have in pocket. Right? That's the optimal way to go about it. In practice, companies don't tend to follow that policy. Right? We have seen over time that increasingly few companies are paying dividends, which tends to be a little bit more in line with this idea that companies shouldn't reinvest their profits rather than pay them all out. Only under the condition that, right, they don't have value-adding investments to pursue. But for the most part, after you've read that Fisher Black paper that sums it up pretty much perfectly, overall, we're not sure. Right? There's a lot of competing reasons, both within the firm and outside of the firm, on why a company should pay dividends. Right? So within the firm, dividends in themselves are pretty sticky because financial markets react very strongly to dividends being initiated or stopped or changed. So doing so can be highly erratic on the company's capital structure and therefore the discount rate that they're applying. Right, so that can destroy value. On the other hand, right, simply canceling paying a dividend can be a great source of external capital to the firm. Right, so rather than paying out $100 million in dividends this year, the company could instead reinvest it if they happen to have an investment opportunity available to them. Right, but in practice, companies tend not to do that. Investors also are going to be split on things that might be a good idea on why to pay dividends or not, right? So if you're an investor with relatively high wealth, then dividends are going to be a little less preferred, everything else equal, because you're going to be paying higher taxes on that, right? You're going to have that double taxation issue you hear with dividends. The dividends are coming out of net of tax profits that the company's paid out, and then they're going to be taxed when they're distributed to you as shareholders, right? So you're going to be paying additional tax. On the other side, lower income investors, they're not going to have that same concern. Right? They're going to pay out relatively lower tax rates on those dividends, and it's not going to matter as much. Right? So why do companies pay dividends? Optimally, it should be to maximize value. In practice, we're not entirely sure. There is some evidence that companies somewhat play somewhat of a value maximization role historically. Right? They've reduced the amount of dividends being paid out, but there's not a clear-cut answer. Right, there are a few things that we do know that kind of line up with this optimal dividend being paid out. Profitable companies are dividend payers. Right, if companies have the money to support paying a dividend, then they can afford to do so. So we tend to see larger, profitable companies paying dividends. And on the flip side, there are companies that, while being profitable, don't have many investment opportunities available to them. Right, meaning they don't have that return on investment that would justify holding on to that capital. Right, so it makes sense to be paying dividends. Right, Apple is a great anecdotal example of that. It's a very profitable company, and they started stockpiling an increasingly large pile of cash over time because they had so much money being generated every year, but they didn't have investments to allocate that money to. Right? And over time, investors got increasingly frustrated with the company that, hey, you're just generating a cash stockpile. You're not doing anything valuable with it, not investing it. Give us the money that's just sitting there. Right? And so that's a great example of those limited investment opportunities coupled with a very profitable company. Right? So while they might not have the investment opportunities that would justify investing the cash, they have excess cash growing over time. So instead of it just sitting there, they can pay it out to shareholders. We have seen that dividends have decreased over time, in part because of the changing characteristics that we've seen. Less profitable companies have a tendency to list. We've seen smaller companies have a tendency to list. There's also been the changing investment opportunity over time. Dividends can affect investors, right? But mostly around the tax basis, whether they're high or low tax. Right? So again, with any other question we're dealing with the company, bottom line goal is it adding or destroying value? With capital structure policy, the way that's going about happening is through minimizing company's cost of capital. Right? By minimizing the discount rate, you're increasing the company's value. Right? In addition to that, there's the reduction of the issuance cost itself of capital being listed. Right? And then under the pecking order theory, we see that companies are listed in their cost of capital itself, but also relative to their issuance costs. Right? Using cash you have on hand doesn't cost you anything. Raising a seasoned equity offering is going to cost you a lot of funding. Right? Somewhere typically between 3 and 15%. Right? So if you're raising $100 million, you can pay up to $15 million in capital to investment banks that are underwriting that process. Right? So raising capital itself can be very expensive. So very important that companies exhaust the cheapest sources first before getting those more expensive sources of capital. And then we have the optimal capital structure theory, the Modigliani and Miller theory. And that's basically where companies are trying to balance their debt and equity to minimize their cost of capital. All right, so the exam itself, it'll be on D2L under the quizzes section. You'll have 8 to 12 questions in pre-response format, meaning the question will be posed and you have to reply to it. They are qualitative, meaning you're not going to have to calculate anything. You're not going to need Excel or a calculator. You are going to have to be familiar with the primary formulas that we've gone over. You're going to have to understand time value of money, net present value, discount cash flow, how to calculate cash flows, right? The methods for calculating WACC and all that. You have to be familiar with them. You are not going to have to calculate any of them. So make sure you're conceptually familiar with them. It's all open notes. You can search the web for answers if you like. I don't encourage you to search the web. I can tell you, I've looked up some of the answers for some of the questions, and some of the top results for the questions themselves are incorrect. So I would not rely on that. Use the sources that are in the webs that are in the course on D2L. However, you are not allowed to work with another person. If there's any hint of working with other students, it will be an F on the exam. Fortunately, my first semester teaching at MTSU, I had students that did not believe that. It's very easy to see on this sort of exam when people are working together, and half the class ended up failing because they worked together. So don't do it. I believe in you all to do a really good job. Your problem sets, you all did a great job. I think it's the highest grade average I've seen on the problem set. So very confident that you'll be able to do well on this, right? You wouldn't be able to get through the problem set without having pretty good understanding of what we've covered. So don't work with anybody. Do this on your own. You'll have 3 hours on October 6th to finish the exam. The hours start as soon as you open the exam. So don't start the exam until you're ready, but make sure you have it submitted before midnight. Right, the exam will close at midnight, so make sure you start it before, what would that be, 9 p.m. To make sure you get it finished in time. And it's only going to be one attempt. Right, so in studying for this, if you haven't read it already, I highly recommend reading the course notes that I posted. It's only about 30 pages, but gives a really good breakdown of the topics in the course. And from there, go through your Excel practice. You can go through your problem set. Important questions to ask yourself is, right, while you're calculating answers, why is it you're calculating it this way, right? So why are we adjusting for time value of money when we're looking at present values? You know, how are we calculating free cash flow in these capital budgeting problems and stuff like that? And then you also have the recordings and PowerPoints available. All right, so that's all I've got to say on this. I want to open it up to questions now that any of y'all may have.
Dr. Jensen, so you can only take the test on October 6th, right?
Correct. It's available for a 24-hour time period, available all day, so take it whenever works best for you, but it has to be done that day.
So we won't get our grades back immediately since they're like free response questions. So you're going to
Correct.
grade them individually.
Yeah, you have to go through them. That actually reminds me though, it might give you a grade. I don't remember if I turned that off. Ignore that. If you get an automated grade response, just ignore it. I've got to go through them myself.
I just wanted to double check. You may have already said this, but it's just the 8 to 12 free response questions, no conceptual, right?
It's all conceptual. Yeah.
Oh yeah, sorry, I meant computational.
Right. Yeah, not
Yeah.
computational. Yes.
Thank you.
Dr. Jansen, I noticed on the study guide, it was understand forecasting errors. Can you just kind of go over like what you mean by those?
So I think I ended up not getting into that in detail this class. So basically by forecasting error, issues in model inputs and issues in using the wrong model for the most part, and then sensitivity of input. So right, we're applying models to actual data, so it's important that we have reliable models, which basically stems from using something valuable like net present value. So if we have a reliable model, next we need to have valuable inputs to them, right? So that we're including inputs that make rational sense. So for example, I had a couple of you sending me emails asking me questions about, does this valuation make sense? You want to be able to make sense of the model inputs and answers you're getting with those inputs in the model, right? So for example, if you're getting a negative firm value, right, that might be one indication that something is wrong. So when you're dealing with a financial asset, the lower bound value of that is going to be 0, right? If an asset is generating or destroying so much value that you're getting to a negative point, people can just stop running the company. They can sell it off. Basically, they would be adding more value to shareholders if they stop production, shut the whole company down rather than generating negative values, right? So making sure that you're getting reasonable answers out of that. So I also had other people asking me about like over their sample period, they had something like 130% growth rate, right? And so 130% growth rate would be insane in perpetuity, because eventually that company, even if it's starting off as a $1 million company, if it grows at 130% in perpetuity, eventually it would be larger than the overall economy it's operating in, right? So stuff like that doesn't really make sense. So you want to make sure that you're using valuable models, NPV, and you're using reasonable estimates into it. And there's basically ballpark ranges for what reasonable estimates are, but it's kind of up to an individual to understand what makes sense in every specific circumstance. And then there is going to be the sensitivity of it. So you saw that a little bit in dealing with the interaction of your WACs and NPVs on the problem set, right? And basically what you saw is that inverse relationship with present values and discount rates, right? When you created that table with the weighted average cost of capital and the discount rates, or weighted average cost of capital and NPV, you saw that negative relationship in play. And that's basically a reflection of sensitivity of inputs. Right? Slight changes in our discount rates can result in drastically different values. So it's important to understand that any small change that we might make in our models and inputs to those models can have drastically different changes in the resulting value that we're getting out of them. It's so important to keep in mind that every decision that we're making can have a drastic effect, even if it is relatively small. Any other questions?
Hey, Dr. Jansen, I apologize if you already mentioned this. We don't actually have class next week, correct?
Good point. Correct. yeah, it's just for the exam time period. So you have 24 hours to take it, right? This class was set up on a specific time, so class time is a great time to take the exam as well. But yeah, just want to make sure everyone has the time to take care of it. No class
you.
that day.
Could you go over again, dividends portion? And as you said, why do firms pay dividends? And I understand a lot about that in the past when that was kind of a newer thing. But now when dividends are not being properly increased percentage wise as they were back then, it's kind of a little bit obsolete.
So I'm sorry, what exactly is your question, Brayden?
Could you explain more on why dividends would be valuable now in the present?
So that largely comes back to, let me actually pull up the Excel sheet. Right, everything comes down to, is it adding or destroying value? So under dividend policy, it largely comes down to the return on invested capital. Right, so in the case where our return on invested capital is greater than the discount rate, the company is going to add value by increasing its retention ratio. Right, so in other words, lowering the dividend it's paying out. On the flip side, right, if we have this return on invested capital, again, greater than the WACC, and we were to increase our payouts, in other words, to reduce our retention ratio, we'd be lowering value, right? The company would be better off investing in itself, right? And we can kind of look at the trade-offs here, right? So in the year that we're making this decision, right, if we're increasing our retention ratio, we're reducing the company's cash flow, right? Why? Because we're increasing how much we're reinvesting that year. Right, so rather than taking the profits, rather than taking this cash flow, paying it out to shareholders, we're taking it and investing it. When we invest it, what is that going into? Right? What in the cash flow, where is it? What in the cash flow formula are we putting it into? Capital expenditures. Okay. So when we invest in the company, that's going into capital expenditures and reducing our cash flow in that year. But because we have a relatively high return on invested capital, we're going to be increasing the company's value overall. On the flip side, we would be increasing our cash flows in the short term if we were to reduce our retention ratio and pay out more cash in the form of a dividend. But again, because we have a higher return on invested capital, we're going to lower the company's value because we're basically foregoing valuable investment. All right, so the best decision, or the best framework for a dividend policy to be centered around is simply just comparing the return on invested capital relative to the discount rate. If you can get a higher return on capital by holding on to that money and reinvesting it within the company itself, that's what should be done. If on the other side, or on the other hand, return on invested capital is lower than WACC, then excess cash should be paid out in the form of dividend. It's not worth reinvesting within the firm. So basically it comes down to, is return on invested capital greater than WACC?
Thank you. That was a great explanation.
Actually, let me show you the opposite effect. All right. So let's say the company has a lower return on invested capital than its WACC. Right. Look what happens now when we're comparing dividend decisions. Right. Increasing our retention ratio is now lowering the firm's value. But paying out more dividends is increasing the company's value. Right. It's going from 220 to 240. Right. So it all kind of depends on what the return on invested capital is relative to the WACC. What else?
I have a quick question unrelated to this. So if I just figured out that I did something wrong on my project, is there a way to resubmit it and do a second submission?
Yes, you should be able to submit another time. So go ahead and do that through detail. If for any reason there's an issue, send me an email, including your attachments, and make sure to note in that email to ignore your submission in Dropbox.
All right, thank you very much.
Dr. Jansen?
Yeah.
You wasn't there like another discussion post that's supposed to be open like today or tomorrow?
So I have the 3 discussion posts. The dividends one is the last. Oh, dividends is the last one.
Is it due tomorrow or is it
Yes.
open tomorrow?
Yeah, it's due tomorrow.
Okay. For some reason though, that whenever I opened it, it wasn't like showing up. But okay.
Yeah, September 30th, 2022.
Okay. Gotcha.
Dr. Jansen, on the study guide, it says there will be several questions about interpreting the project. So does that mean you're just going to have like some different scenarios?
So not necessarily scenarios, but in a way, kind of just asking you questions that you should already be answering in your presentation, your write-up, right? So like what the relevant factors are in valuing a company over the long run, what inputs we need for that, what information and sources do we use to get those inputs.
Okay.
So more conceptual than specific calculation.
Okay. Gotcha.
Hey, Dr. Jansen,
Mhm.
is there an ideal length that you want the answers of on the exam? Because I'm generally pretty brief.
Brief is fine, so long as you're sufficiently answering the question. I would guess the most would be about a paragraph. And I think for a lot of them, the minimum would be a couple sentences.
Okay, thank you.
Anything else? All right. Well, if there isn't any other questions now, that'll be it. Don't forget to get your last discussion post posted by tomorrow. After that last one is posted, I'll go through and finish grading your participation grade on that. If you have any questions after tonight, please post them in the discussion boards. You probably won't be the only person with those questions. There's not a dumb question. Feel free to ask whatever you want. Yeah. So if there isn't anything else, I hope you all have a good night.
Professor, what was that
Yeah.
last thing you said, about discussion?
There's one more discussion post due tomorrow. Dividends, what do we
The
know?
dividend one? Oh,
Yeah.
okay.
Yep, and that'll be the last discussion post.
There was a total of 3 discussion posts, right?
Yep.
Okay, thank you.
Are you offering any bonus points for filling out an evaluation on your course?
Good question, Liz.
Actually, yeah, sure. Yeah, why not? So let's see. How about if at least 60% of the class responds, then I'll give 2 points to the final grade.
Sounds good.
All right.
Thank you. And thank you, Liz.
Appreciate it. Yeah, thank you.
Thanks, Dr. Jensen.
Deal.
Yes, thank you both.
Thank
Yeah.
you.
Yeah, why not? Please though, when you do fill out the the course response, it really helps me see what I can improve in the class, what the strengths and weaknesses are. So any comments you have would be great. I still don't feel entirely comfortable teaching online courses. I'm used to in-person courses, so it's been a bit of a change. So any suggestions you have to improve teaching online would be great. Yeah, or if there's anything else you see that could use improvement, let me know.
Well, you've done a great job. Thank you.
I appreciate that. Thank you.
Yes, you have done a great job.
Thank you. All right. Anything else? All right. Well, y'all are going to do great. If you have any questions, discussion boards, yeah, get that last discussion turned in by tomorrow, and I'll get those discussion participation grades graded over the weekend. Actually, probably Sunday or Monday. Yeah, by Monday, I'll have participation grades posted. All right. Have a great night, everybody.
Bye.
All right, take care.
Thank you.
Thank you, Dr. Jansen.
Thanks, Dr. Jensen.